right, perfect. Welcome back to the podcast, Business Exit and Acquisition Playbook. I want to introduce you to a good friend of mine. I've known Ryan for a number of years. Our paths have crossed. He's done a bunch of valuations for some of my buyers, but he's my valuation go-to guy. So I wanted to bring him in, talk all things valuation so that you guys as buyers could have a good resource where to go if you need a valuation, but also understand how to value some of the businesses you're looking at. Ryan, why don't you just give them a quick background on yourself, how long you've been doing valuations, and anything else you want to share?
Yeah, so thanks for having me, Trent. So, background, I've been valuing companies for 10 years. I started my own firm 7 years ago, and today, my company, Peak Business Valuation, we value 25 to 35 companies a week for individuals buying and selling businesses all across the country.
Nice, perfect. When it comes to valuations, let's just dive right into it. What are buyers looking for? Should they be looking at asset value? Should they be looking at multiple of earnings? And when is it appropriate to use one versus the other?
Yeah, good question. Ultimately, it comes down to understanding more of a holistic way to assess. So for us, for being certified appraisers, like we look at every valuation approach that's applicable. So whether we're looking at the asset value, which really only comes into play when we're looking at asset heavy companies, like for instance, a machine shop. Like ultimately for me, I can look at when I'm on a phone call with someone buying a machine shop, it's like, are the margins greater than 10%? And if the answer is no, generally speaking, the machinery is going to appraise more than the cash flows would imply if we looked at earning based multiples or a cash flow analysis. And so the asset approach, or looking at the asset value, it truly depends on the type of company. Also, if the company is not making any money, you can't really look at an earnings based approach. So it really just comes down to the asset value.
I often tell my sellers when I'm dealing with sellers, if the business isn't that profitable, but they got a ton of equipment that, and you can correct me if I'm wrong, maybe I'm being too blunt here, but I tell them, look, your business is worth more dead than it is alive. You got to look at liquidation value at this point. It's not going to get a traditional multiple of earnings and then have a lender come in and service the debt to justify the valuation.
Yeah, it's so true. Some companies have so many assets on their books that just either sit or just they're not operational because the business shrunk. And it's okay if your business is shrinking from a revenue perspective, but you have all these assets, like you should just sell the assets that aren't even being utilized. So we just worked with an e-commerce business, and the value of the company came in like negative 800,000, and it's because they've just been hammered by tariffs and just Amazon. And so regardless of them doing 12 million in revenue, when you're losing money and you don't have a good inventory management system, the asset value can also be negative as well.
So let's focus on what we want to see buyers get, which is some sort of a profitable business where they can use a multiple of earnings. But just touch on that approach. What do they need to know without trying to make them valuation experts, but just from a buyer standpoint, a multiple of earnings approach? What's the high level? What do they need to know to be able to do back of the napkin math here?
Matt, yeah, it's important to know that a multiple, and any type of multiple, is really just a derivative of the earnings and risk. And so when assessing a company and looking at multiples, especially EBITDA, which is earnings before interest, tax, depreciation, amortization, or seller's discretionary earnings if you're looking at a smaller business, or SDE, like ultimately the key thing to know is most businesses shouldn't be transacting greater than, let's go with a 4x EBITDA multiple. And if you just do the inverse of that's 25%.
Cap rate, basically.
Yeah. And so, like, when I'm talking to people and trying to explain looking at multiples on cash flow, it's okay. If you could get a 25% return on your money and that justifies the risk you're going to inherit when you take over the company, if you're paying a 4x multiple is 25% return, this is simple, is that worthwhile for the risk you're going to take on? And for a lot of people, the simple answer is no. And that's why a lot of people divert to 3x multiple as like a rule of thumb because it is simple math. It's talked about all over the internet. Whether or not it's accurate is a different story. But that's a good place to start because a 30% return on your money this is starting to make more sense because it's a small business is riskier than real estate. It's riskier than the stock market. And so it's what type of alternative investment would you be willing to take on and what risk?
And not only that, in the small business space, the Main Street market space, if you push it up to a four multiple, it becomes really hard just to get the DSCR ratios to be where they need to be. Anything above that, once you factor in a buyer's livable wage, depending on what that is, there's just not a lot left over to service the debt. And so that's a good general rule of thumb. And previously to this video in the course, they will have seen I have a whole section about not confusing SDE with EBITDA, two different multiples, and don't apply the wrong multiple to the wrong figure. Otherwise, you can get upside down really quick.
Yep, that's one we see so often is EBITDA is always going to be a smaller dollar figure than seller's discretionary earnings because you're deducting that fair market replacement salary for the
Right.
officer. And so therefore the multiple for EBITDA should be bigger than that of seller's discretionary earnings. So yeah, we have a lot of discussion with buyers and sellers and brokers just on that topic by itself.
Yeah, just getting good information out there on the market. When it comes to add backs, calculating EBITDA, SDE, what are some general, again, from a buyer's perspective here, what are some general, like, safe add backs that you, from a valuation standpoint, that a lender is going to generally accept? Again, I've got some videos prior to this where we talk about like how to back into that figure and what you can accept, but I want to get your perspective of there. What's a general kind of list that you like to say, yeah, that's a safe add back?
Yeah, so for us, it generally comes down to one key question to start with. Like, what expenses are needed to operate the business and what expenses aren't? And so when you start going down the list of expenses, let's take a restaurant for instance. Whenever you see auto expense and you see a vehicle in the depreciation schedule, and you're like, okay, you have a Chrysler minivan for a restaurant. Like, that doesn't make any sense. And you don't have any revenue coming from Uber or any other kind of delivery service. So therefore, that auto expense should be added back. And that comes down to fuel, insurance, and repair and maintenance. And so looking at what the business model is and what are normal expenses associated with driving that. Another kind of easy expense that comes down to is travel. So for most businesses, it doesn't require travel. There are some business models that rely on trade shows or traveling to clients. But when you see large expenses where as a percentage of revenue, and you look at industry peers, it's 10x what industry peers are. You know that there's something personal. I bought a water softener company in 2021, and that individual expense personal travel to different countries where he would go for 2 weeks a year. And you're like, okay, you sell water softeners and install water softeners.
You
You
know that's
shouldn't.
personal.
Yeah, it's definitely personal, and you have credit card statements to show that yes, that is indeed personal. So like there's quite a bit there. Life insurance expense or key man risk expense associated with the owner. Like that one's a little bit of a gray area because it's always comes down to is that going to apply to the next person that operates it or another key person at the business? Employees like or family members that are on the payroll but aren't
Mm.
operating in the business. That is one of the biggest issues is trying to identify everybody who's receiving a W-2 and seeing who actually works in the business and then adding back everybody else that is not.
Or the opposite approach, family members who are working in the business but not getting paid anything. You got to factor
Convenience
that in.
stores.
Yeah. Yeah,
The
exactly.
convenience stores are, we have a lot of issues with some lenders over convenience stores because a lot of family members work for free in the business, and you're like, wait a second, you're telling me that only one person operates this business 7 days a week
Yeah,
for
24
at
hours a
least.
day. Yeah. Got it. What do you do with cash? I know when I deal with sellers who are like, yeah, but I have this extra $100,000 a year cash and I can show it on my POS systems, but it's not on my bank statements. I've taught my buyers that they just completely ignore it. But what do you do from a valuation standpoint?
We also tell everyone to completely ignore it. Primary reason is if they're collecting cash, not reporting it. One, there's generally not a paper trail to follow. And so if we're doing extra work like a proof of cash where we're verifying the P&L versus the bank statements, we can't verify where that cash is. And two, they've already evaded taxes. So therefore by evading taxes, they've already received their kind of savings from not paying taxes. And so it's either they amend all their historical tax returns to show that, or we just stick with the current financials that neglect and leave out cash.
Yeah, we're right in line. In the previous videos that when I talked about this, I told them the saying I tell my sellers is you got the benefit when you stole it from the IRS. You're not getting the benefit when I value the business.
Yep, 100%.
Yeah. Yeah. I hear about this going concern valuation. Is that basically the same thing as a multiple of earnings approach, or is there much of a difference? Is that even, there's a buzzword of the going concern. How would you define that?
Yeah, so for us, from a vocabulary standpoint, like we have what's called premise of value, and it's either going to be going concern or liquidation value. And so going concern means that the business is going to continue operating as is, whereas the other premise of value is liquidation value. Going back to your previous example, the company is worth more dead than alive. And so, why would we look at the value as if it was going to continue operating? We're just going to look at it as if it were to stop operating day one. So,
Yeah. So here's a pet peeve of mine, and you can tell me if I'm totally out in left field, but I see so many brokers do this, and it drives me crazy because I think my personal opinion is I think it's totally wrong. You'll have to tell me from a valuation standpoint if I'm at all out in left field or if there's maybe some middle ground I should be a little bit more lenient on. But sometimes I get sellers that say, okay, I'm willing to sell my business for 3.2 times SD, whatever it is. But I've got this $600,000 of inventory. And so I need the 3.2 times plus $600,000 of inventory. Or I'll see brokers that do that. And I'm like, no, we are not doing that. It's not how it works. A going concern valuation means that if you needed that whatever let's say the business made $200,000 profit SDE, we're applying a market multiple 3.2 times, but the inventory, if you take the inventory out, the $200,000 of SDE is impacted, so you can't pull it out and be separate. It's either included and we get a fair market value, or we're going to get a really low discounted multiple and try and get a
mm-hmm.
one times SDE plus inventory value. What's your approach there?
So our approach would be very similar to how you just explained it. Ultimately, whenever we come across transaction structures where it breaks out, this is what we're transacting at plus inventory, which for convenience stores or liquor stores, it's very common with liquor stores. We always have conversations with them because ultimately the inventory in place on the books of the company is what's needed to generally like produce the revenue that's currently being realized by the liquor store, for instance. But when we look at the inventory, we that's when we start looking at industry analysis and start looking at okay, and I'll put a plug for a cool resource. It's called bizminer.com. They it aggregates all tax information, and so you could look up NAICS code, look at the state, and then look at kind of revenue criteria, and it'll produce 5 years of historical balance sheets and P&Ls for all the companies that fit that criteria. And when we're looking at liquor stores, for instance, for a company doing 5 million in revenue, we're wanting to look at what's a normal level of inventory that's reported on the books of the company for all the liquor stores that report tax info to the
Yeah.
IRS in Nevada. And so we're looking at these companies and it's okay, as a percentage of revenue, it should be, let's use a round number, 10% of revenue should be in inventory. And when we look at the company's books and we see, oh, they're at 9%, it's okay, then really they're, all the inventory is for
Included.
operational needs,
Yeah.
it's working capital.
Yeah. Yeah, here's an interesting side note. I've done this a number of times where there is excess inventory.
Mm-hmm.
Because what I try and tell these guys is normal levels of inventory are included. If you've got excess inventory, especially if there's like a lot of excess inventory, what I've done in the past is normalize inventory. Normal inventory levels are included, and then the seller will, in fact, there's a deal I'm doing it right now in escrow. They've got a $1.2 million of wheels and tires. They probably need about $600,000. That's about normal. So $600,000 included, the excess inventory is going to be sold off on consignment at cost as the buyer needs it, and the seller essentially becomes the supplier until they buy off the inventory, at which time, if they don't buy it, then the seller can liquidate it off. So that's worked well for me in the past when we've done situations. Have you seen anything like that or other alternatives to that?
No, but that's actually pretty brilliant because ultimately, like, it helps eliminate any obsolete inventory that may just sneak into the books of the company that's been there for years, but it's never going to move. So yeah, that's actually, I'm gonna take that and share that with people because that's
Yeah,
an
it's worked.
interesting.
I did it for another deal just a little while ago, a sunglass company. They specialized in selling sunglasses to marathon runners. That was like their niche. And for whatever reason, during COVID, they just got really bloated. And obviously, that's a hard pill to swallow when your business is worth less than the inventory value. And so we
Mhm.
normalized it, and seller just sells it back at the consignment. So in theory, they essentially kind of recoup their cost in time, and it's no skin off
Yeah.
the back of the buyers because they got to buy the inventory anyway. So if they're buying it at cost, what would be a fair market cost there, both sides are getting close enough to being satisfied.
Yeah, and it mitigates a lot of risk on the buyer's part because the
Mm.
buyer doesn't have to purchase all the excess inventory dollar for dollar right up
Yeah,
front.
yeah,
And so it
exactly.
allows the purchase price to be more normal. And
Yeah,
just, yeah, that's actually really smart. I like that a lot.
yeah. All right, steal it. You can use it. Tell me about weighted averages. When it comes to you're looking at a business 2022, 2023, 2024, and obviously it's up, it's down a little bit. How are you weighting the average SDE, the average EBITDA figure? Are you looking at just a straight line average? Is it a weighted average? Is it all based on the trailing 12 months? What do you typically look at?
Yeah, that one's always a hard one to answer because it, at the end of the day, it depends. And it truly depends on the narrative or kind of the trajectory of the company. So, for instance, a business that we were looking at today, revenue in 2018, 2019 was on an upward trend and then it peaked in the COVID years and then it's been on a downward trend. And it's because there was a lot, it was a furniture store. And so a lot of capital was spent on furniture and floor coverings and tile and remodeling. And so like they went from a peak of 33 million to now they're doing 21 million. And so obviously looking at the historical years, it's like you can't rely on COVID years. You look at 2019, 2018, and the last 12 months is higher than those years. And so it came down to having discussions with the seller, the broker, and the buyer, and then digging into kind of the industry and the socioeconomics of the area in which their 6 store locations were servicing and where was the growth taking place. Is the area growing? Is it sustainable? Is it flat lining out? Because between 2015 for an interim in 25, sales are actually up 2%. And so it's okay, like there's what's the narrative? Like if generally speaking for us, we like starting with trailing 12 months unless there's something in the history that would change that. For instance, like a roofing company in Texas or Florida, like you have storm damage, which skyrockets sales for roofing companies. And if there's no storms the following year, revenues kind of down tremendously. And so for companies like that, you're going to do an equal weighting
Yeah.
across like a 3 to 5 year period. Or if you have a company that has contractual revenue with the government and it's steady pace, the only thing changing is expenses on a year-over-year basis because revenue is constant. Like for those, it doesn't matter if you look at trailing 12 month or wait. So the narrative and where the company is at today versus where it's going in the near future, like that helps us understand how we weight financials or SDE or EBITDA.
Yeah, I usually tell my buyers if it's steady or increasing, we can look at a weighted average. If it's trending down, I don't care what they did in 2018. If it's trending down, we're just looking at the most recent period. Yeah.
Yeah, it's just hard because like, we dealt with, so about 3 hours ago, I signed off on an e-commerce business that dealt with a very interesting novelty product, and like their growth was like 1 to 2 million a year in revenue above the previous year. And so like you, in that case, you can't look at historical financials because the business next year is going to be different than it is today just based on growth. And so in that case, we look at projections and we want to kind of project it out as to like when is the business going to top off to
That's
a
tricky.
normal stagnant rate.
Yeah.
And yeah, so it really depends on this the kind of status of whether it's growing, stagnant, or declining.
I totally get that from a valuation standpoint. You're trying to project and then discount or bring it
Hmm.
back down to present valuation. But a lender, they don't really look at that from a cash flow standpoint. So, from a valuation standpoint, there's one way to look at it, which totally makes sense. But from a lender, they're not really going to look at that. They're just going to look at historical performance and how it support the debt, right?
That yeah, that it truly depends on the lender. There are some lenders that look at the cash flow, but they also look at the projections. Like in 99% of cases, we don't look at any projections by a borrower for an SBA business valuation because more likely than not, they're incorporating changes that they expect to make and not what the business is going to continue doing if it were to stay in its current position. For this business, the one that I mentioned, the novelty business, the bank was the one basically saying, hey, we're only looking
Interesting.
at projections on this one.
Nice.
And the good thing is, from a debt service coverage, 2024 supported debt service coverage. And so they're like, we're good with this. But
Yeah.
because the company is growing, like it's going to be a higher multiple. And the way it was structured from a transaction standpoint with the terms in the purchase agreement, like that's the only reason why it made sense was because of the terms in the PA.
Yeah, that's interesting. Speaking of multiples, what do you use to adjust, or how do you look at the multiples and then make adjustments up or down? And you, again, you can tell me if I'm wrong here, but sometimes what I'll do when I look up a market multiple, let's call it a whatever, 2.8, I'll
Hmm.
look at then the individual characteristics of the business, good or bad, and then start with that 2.8 and make adjustments that could go up or down for that. Are you looking at something, and what are you looking at to make those adjustments, if you are?
Yeah, so we do something very similar. So we, as part of our risk assessment, we call a portion of it company specific risk premium. And it's primarily associated with the cash flow analysis of the income approach for valuation. But when we're looking at market transactions, everyone should know at this point between buyers, sellers, brokers, and valuation professionals that the information put into all these private transaction databases is only as good as the individual inputting it. And it's like, for instance, like peer comps is a very common one used by SBA. and it doesn't have that many data points. And so, because it doesn't have that many data points, you're trying to assess a huge kind of grouping of transactions, and let's just say FedEx routes. And so you're like, okay, if we take this grouping of FedEx routes and we just look at it like the average is where we are, we have financial performance that we can look at and do, is it above average or below average? Another key one is looking at management personnel. How involved is the officer versus another key individual? And the employees, how easy is it to manage the operation? Is it above or below average? And so we do that, and I would assume very similar to your approach, where we go through like various risk factors of the business that are very common to that particular business model and industry, and look at the multiples, look at average, and is it above or below? And then at
Yeah.
the end of the day, we select after we do that, like what percentile is most applicable that represents that risk analysis relative to our cash flow analysis.
Yeah, I always tell my buyers and sellers the multiple is another way to explain the concept of a market multiple is a confidence score. How confident are they that the business's performance will continue, and what's that risk? It's essentially measuring that confidence. Sloppy books, low reoccurring revenue is going to be lower confidence or lower multiple. Reoccurring revenue, clean books, operating without the owner having to be there full time is higher confidence. So multiple goes up. So pretty common sense way to approach it.
Yeah, it's always fun looking at multiples because you have different databases, but at the end of the day, all those databases that collect private transaction data, it's just a fraction of what actually happens
Mm,
in the whole small business transaction space. And so if the multiples are being derived from the database I mentioned earlier, peer comps, more likely than not, they're always going to be on the higher end just
mm.
because they qualified for SBA financing.
Yeah,
And
exactly.
so when you're able to qualify for SBA, you're able to leverage, therefore resulting in a higher implied value for a business. Whereas if you don't qualify for SBA, generally the purchase price is lower, resulting in a lower multiple.
Yeah. When should a buyer get an appraisal? At what point do they reach out to you if they wanted to get one? In other words, I mean, you can talk about general divorces, disputes, that type of stuff, but if a buyer's trying to buy a business and they are working with the lender, can they say, "Hey, Mr. Lender, I want Ryan's company to do my valuation."
Yeah, so a part of the SBA lending process, the bank's always generally going to get a business valuation from a third party that's independent. If you're buying a business and you're already working with the lender, you can most oftentimes say, hey, let's order a business valuation before we dive deeper into underwriting because I want to make sure that it pencils out ahead of time. And if you're ordering it through the SBA lender, then it's already going to qualify for SBA lending because it's going to be addressed to the bank and to the Small Business Administration. And more likely than not, that lender is always going to give you the report. But if you're not working with an SBA lender, let's say you've signed a letter of intent and the seller is starting to send you documents that you've requested through like your Google sheet that you've outlined, this is all the info we need. That's one of the more optimal times to get a business valuation is when you start asking for this information. Like we work with a lot of buyers prior to an LOI and it's like, hey, here's our document request list. This is generally what we need, but we won't work with you until after an LOI because now we can actually get the information we need without you being questioned why you're wanting this before you make any sort of commitment. And so we either work with the buyer in SBA underwriting or right after an LOI is signed because that's the easiest way to help them in due diligence is by helping them understand risk and how we're looking at it. But also, once we do the valuation, give it to them, like they start seeing other questions that they want addressed and hone in on that we pointed out as red flags, or not necessarily red flags, they're just details that if they were to be different than how we expect, then it would greatly impact the whole analysis.
And let's say a buyer contracted with you to do a valuation in the LOI phase during due diligence, but before approaching a lender, could they then take that valuation that you've done and give it to their lender and satisfy most lender requirements that are going to need a bank to order a third party valuation?
That's a great and hard question. So, with this new SOP from the SBA kind of in June, it outlined that the bank cannot rely upon any business valuation that is ordered by the buyer, seller, or broker.
Mm,
And so, like the business valuation that we performed, it creates a great, like, it can't be used by the bank. There are some SBA business valuation firms that will skirt around it, but as part of the appraiser's kind of certification for any valuation engagement, you basically have to state that we valued this company within the last 3 years. And
got it.
so, like, for us, we always tell them that our valuation can't be used just because we are on the side of the SBA lender from the standpoint of if there's anything that puts a guarantee fee at jeopardy, like we don't want to be the reason why
Yeah.
that is if that business goes south. And it's because the SBA, when they were auditing, because the bank's trying to get their guarantee fee, they're like, hey, like this business valuation was ordered by the buyer and somehow used for the SBA loan. That's a no-no. And then it looks bad on them because they don't get the guarantee fee, and then it looks horrible on us. So we always say, hey, let the bank order from a different firm.
Got it. Okay. Anything else a buyer should know about valuations? Otherwise, I'll have you share your contact details so that they can reach out to you if and when they need a valuation.
Oh, great question. If so I've bought a couple businesses, so I'll look at it from my perspective of buying businesses. So I own two plumbing companies, a couple restaurants, and a striping company. And one thing I've learned in buying businesses is it is so easy to get lost in the due diligence that you're performing. No matter how good your due diligence process is, you're always going to miss something. And so, hiring kind of outside parties or consultants or people on an hourly basis is a really nice feature if you have the capital and means to do, just because they're going to look at it with a clean set of eyes with no bias towards the situation, whether it's in your favor or not in your favor, and they're going to lay out the details. When I've bought businesses, I reach out to other valuation firms to value it for me because I want them to tell me what I'm missing. It gives me an excuse to look at
How they work.
customer relation, the valuation process, and the product of another firm. I always switch firms, and sometimes I've actually purchased multiple reports from one firm and another firm because I want differing opinions. Because at the end of the day, like a business valuation, really we're being paid for our opinion. So it's our professional judgment that's coming into play. And every valuation firm, depending on their level of expertise, whether it's in the industry or broad set or they just do a high volume like we do, there's always something else that they're going to see that might be a game changer that you want to implement in your process when you're buying.
Yeah, that's fantastic. Thanks for joining me. Tell anyone listening here, how do they get a hold of you? How do they reach out to you if they want you to help them through the process?
Yeah, so they can, I like phone calls. It's the easiest for them. So they could call 435-359-2684, or they could email me at ryan at peak businessvaluation.com.
Nice. Perfect. All right. I appreciate it. Let me stop the
Thanks, Trent.
recording.